Silver was supposed to crash at $55. Then the jobs report changed everything. There are 8 billion ounces of silver that should exist above ground today, based on everything mined across human history. Roughly 550 million ounces are actually available for delivery on the world's exchanges right now. The rest is gone, locked in vaults, buried in landfills as industrial waste, or sitting in forms nobody can quickly turn back into a bar. That gap has haunted this market for years, and 3 weeks ago, it collided with something nobody was expecting. Silver was supposed to break down. The chart said so. The analysts said so. One widely circulated technical model put the number at $55 an ounce, the level where, if support failed, the entire recovery from January's crash would be wiped out. Then the jobs report landed, and in 28 minutes, the entire bearish case fell apart. This is not a story about a number. This is a story about what that number revealed. The mystery. To understand why a single Thursday morning labor report could rewrite the outlook for an entire metal, you have to understand what silver has already been through in 2026, because most of the audience watching financial news only remembers the headline, not the mechanism underneath it. Silver began this year near $71 an ounce. By late January, it had gone parabolic, surging past $100, then touching an intraday all-time high of $121.67 on January 29th. It was one of the fastest, most explosive moves the metal has ever produced. And then, in the span of about 28 minutes on January 29th and 30th, it collapsed. Silver fell roughly 30% in what would become one of the sharpest single-day drops in commodity market history. Margin requirements had been raised. Leveraged positions were forced to liquidate. The paper market broke before the physical market even had time to react. By the time the dust settled, silver had round-tripped from a euphoric high into a multi-month grind, bouncing between the low 70s and the low 90s, unable to reclaim its old highs, unable to fully surrender them either. That's the mystery. Why does an asset with a genuine multi-year supply deficit keep getting knocked down by paper market mechanics that have nothing to do with how much physical metal actually exists? We're going to answer that. But first, you need the context nobody gave you before this story started. Context. Silver is not one market. It's two markets wearing the same ticker symbol. There is paper silver, futures contracts, ETF shares, leveraged derivatives traded on exchanges like COMEX. And there is physical silver, bars, coins, industrial-grade bullion that has to be mined, refined, and delivered into a vault before it can settle a trade. For most of the last 50 years, these two markets moved in lockstep because the paper market was small enough relative to the physical market that its swings didn't distort the underlying price discovery. That relationship has been breaking down. Silver ran a structural supply deficit for 5 consecutive years, from 2021 through 2025, with a 6th deficit year projected for 2026. The cumulative shortfall across that stretch reached roughly 820 million ounces, close to a full year of global mine output. Mine production itself has been essentially flat, hovering around 813 million ounces annually, while ore grades decline and new project pipelines stay thin. Meanwhile, industrial demand keeps climbing. Solar panel manufacturing, electric vehicle production, and advanced electronics all require silver in quantities that can't simply be substituted away. Even after some manufacturers reduced silver loading per solar cell, a shift UBS cited when it cut its 2026 deficit estimate sharply lower in May, the structural gap didn't disappear. It narrowed. It didn't close. So you have a physical market that is genuinely tight, layered underneath a paper market that is leveraged, fast-moving, and prone to violent unwinding the moment sentiment shifts. That's the tension that has defined silver all year, and it's exactly what set the stage for what happened in the first week of July. The hidden layer. Here's what most coverage of the June jobs report missed entirely. On July 2nd, the Bureau of Labor Statistics reported that the US economy added just 57,000 jobs in June, well below the roughly 110 to 115,000 economists had expected. April and May were both revised down, a combined 74,000 jobs lower than originally reported. The unemployment rate actually ticked down to 4.2%, but that was driven largely by a shrinking labour force participation rate, which fell to its lowest level since March 2021. On the surface, that reads as a mixed report. Underneath it, that's a labour market cooling faster than the Federal Reserve's public messaging had been suggesting, right at the moment a brand new Fed chair was trying to project unshakable hawkish resolve on the world stage. Because one day earlier, at the European Central Bank's Sintra forum in Portugal, Kevin Warsh had made his international debut as Federal Reserve Chairman, and what he told the room mattered more than most retail investors realised. Warsh sat alongside ECB President Christine Lagarde, Bank of England Governor Andrew Bailey, and Bank of Canada Governor Tiff Macklem, and delivered a message built on two pillars. First, inflation is still too high, full stop, regardless of growing optimism about AI-driven productivity gains cooling prices over time. Second, the era of forward guidance, central banks telling markets in advance what they plan to do, is over. Warsh, like his fellow panelists, argued that pre-announcing a rate path only sets a central bank up to destroy its own credibility the moment reality forces a reversal. So think about the sequence. A brand new Fed chair spends his first international appearance insisting he won't hint at anything, doubling down on inflation-fighting rhetoric, refusing to even acknowledge the possibility of cuts. And less than 24 hours later, the data he's supposed to be reacting to comes in soft enough that markets immediately began pricing in a lower probability of any near-term rate hike, with some traders shifting toward pricing possible cuts later in the year instead. That's the collision. A Fed chair who just told the world, "Don't expect me to signal anything," got contradicted by his own data before the ink on his Sintra remarks had dried. Escalation. And this is where the second thread comes in, one almost nobody outside specialist commodity circles was tracking. In May, a relatively young exchange called Abaxx launched something the silver market had never had before: a physically deliverable silver futures contract based in Singapore. Not a paper claim settled in cash, an actual 1,000 troy ounce contract, refined to 4 nines purity, with delivery into approved vaults in Singapore, including Brinks, built specifically to serve the solar, electronics, and advanced manufacturing buyers across Asia who need real metal, not a derivative claim on metal that may or may not exist behind it. The Silver Institute's own president called it a meaningful step forward for the global silver market, precisely because it starts closing the gap between where silver's price gets set, largely COMEX, largely paper, and where the physical metal is actually being consumed, which is increasingly Asia. Why does that matter for a jobs report story? Because it's a second, independent piece of evidence pointing the same direction. While the Federal Reserve was performing hawkish discipline on a stage in Portugal, the physical silver market was quietly building new infrastructure specifically because market participants no longer fully trust that COMEX paper pricing reflects real-world physical scarcity. The tighter the underlying deficit gets, the more that disconnect matters, and the more violently price can move once leveraged paper positions get forced to catch up. Historical parallel. Now this is where the story changes completely, because silver has done this before, and the pattern is almost uncomfortably precise. After silver's brutal 45% correction from 1974 to 1976, the metal didn't limp along. It delivered its single biggest percentage gains of the entire decade, the parabolic run toward $50 that came to define 1979 and 1980. After a sharp, margin-driven pullback in August 1979, silver recovered within weeks. In both cases, the mechanism was identical to what we just described: forced liquidation in the leveraged paper market, layered on top of a physical market where the underlying scarcity never actually went away. The investors who sold into those corrections, convinced the bull market was over, were consistently the ones who missed the largest gains that followed, not because they were foolish, because they mistook a leverage-driven flush for a change in the fundamental picture. Sound familiar? Present-day implication. Bring it back to today. Following January's crash, one widely cited technical framework put $55 as the bear target if the $70 support zone failed to hold, a level that had already proven itself as a genuine buying zone on at least 2 prior occasions in 2026. On the other side, the same analysis pointed to $120, essentially a full retest of January's all-time high, if resistance in the low to mid-90s broke with real conviction. The June jobs report didn't answer that question outright, but it materially shifted the probability. A labor market that's cooling faster than expected, alongside downward revisions stripping out 74,000 previously reported jobs, gives a hawkish Fed chair far less room to justify further tightening, even one who spent his Sintra debut insisting inflation remains the priority. Markets reacted accordingly. Rate hike expectations for later this year eased, and Treasury yields moved lower on the news. Lower rate expectations. A still elevated structural silver deficit. a new physically deliverable contract in Asia designed explicitly to reconnect paper pricing with physical scarcity. None of these three things on their own guarantees a particular price outcome. Together, they describe an environment where the $55 bear case gets structurally harder to justify, and the case for a retest of the highs gets a little easier to make. Future scenarios. If current conditions hold, a gradually softening labour market, a Fed that talks tough but has less room to act on it, and a physical deficit that persists even after recent downward revisions, the base case looks like consolidation with an upward bias, silver working through resistance in stages rather than in a single move. Historical precedent suggests that if the labour data continues weakening into the July Fed meeting, and Warsh's committee is forced to acknowledge that reality, regardless of what was said at Sintra, the pressure on paper shorts could intensify quickly, echoing both the 1976 and 1979 recoveries. One interpretation of the more bearish scenario: if the labour market suddenly stabilises and inflation data comes in hot enough to validate Warsh's hawkish framing, the $70 zone gets tested again, and the $55 case gets a second look. Markets may be signalling right now that this scenario carries a lower, but not zero, probability. The Smart Viewer section. While most retail coverage was busy treating the jobs report and the Sintra appearance as two separate news stories, the pattern underneath connected them directly. A Fed chair spent his global debut refusing to give guidance, and one day later, the very data his committee will have to weigh made that refusal look less like discipline and more like a chair caught between his own rhetoric and a labour market moving faster than his talking points. The people watching this video are not the ones reacting to headlines a day late. You're watching the mechanism, the gap between paper and physical, the gap between what a central bank says and what its own data forces it to do next. That gap is where the real signal has been all year. Most investors are still watching the price. You're watching what moves the price. The ending. There are still roughly 550 million ounces of deliverable silver against a world that increasingly needs far more of it than that number can supply. That gap hasn't closed. If anything, the events of the last few weeks, a labour market cooling faster than a brand new Fed chair's rhetoric could account for, and a physical market quietly building the infrastructure to price around COMEX rather than through it, suggest that gap is becoming harder to ignore, not easier. The $55 target was built on the assumption that nothing would change. Something did. Whether that's the beginning of the next leg higher, or simply a pause before the next violent shakeout, may depend less on silver itself than on how much longer a labour market like June's can keep contradicting a Fed chair who just told the world not to expect any warning. This video is for informational and educational purposes only and does not constitute financial, investment, or trading advice. Precious metals markets are volatile, and past performance is not indicative of future results. Always conduct your own research and consult a licensed financial advisor before making investment decisions.